So stocks are trading around record high territories, even though oil is sliding on hopes that the conflict in the Middle East will be contained and not affect supplies. For more on this and other things, let's go to Garnet Anderson, Vice President, Head of Portfolio Management at Tacita Capital. Thanks for coming in.
Thank you for having me.
Are you feeling like this ceasefire is going to hold and the price of oil is going to stay low? Investors seem pretty optimistic about the oil price going down, that this conflict is contained.
They are. I mean, a little bit of the issue is trying to tap dance around the short-term geopolitical events in advance, get the timing right, get the direction right is awfully tough to do. And so what you're trying to do is pick up, is there going to be something that's going to propagate throughout the global economy, the Canadian economy? So oil would be one of those great propagators coming out of the Middle East. So at this stage, you figure it will hold for a degree of time. But let's recognize the three powers that are involved in that conflict can be a little bit erratic, a little bit dogmatic in terms of their views. And I guess a little bit of a benefit, if it flares up again, you know, Canada's the next exporter of energy, puts us in relatively good shape. Not that we want to ride on the back of you know, fracas or conflict elsewhere in the world. So given the energy representation in the TSX composite, I don't think that investors have to do anything special in order to hedge this particular risk.
If oil prices stay down, let's talk about how it affects inflation. We saw the number coming in at 1.7% today, but we know the Bank of Canada likes to look at core, right, without energy. So factor that through for me if the energy prices stay low.
So the energy prices stay low. First of all, we had the reduction or the elimination of the consumer carbon tax. Call that, you know, 0.6, 0.8% of that inflationary effect that will wind its way through numbers when we start to go to year over year in 2026. So you add that back, you're at 2.4 headline. You're again, you know, higher up on in terms of the core. The backstop is it affects different people differently. We know that Canadian households are still suffering from higher inflation, be it on the rental side, be it on the mortgage side, because their mortgages are turning over at higher levels, and we certainly know on the food side. From a Bank of Canada perspective, the big ebb and flow there, it's not as direct as the U.S. where they've got the dual mandate, employment and inflation. Here it's really more centered around inflation and the health of the economy and monetary system. From that perspective, this probably gives them a little bit pause. They've got the June reading that will come out before the next meeting. So if that's nothing dramatic, right now the odds are that it will go in October. And if it goes in October, that's probably the one and done at this stage. If tariffs really come back with a vengeance, then you would think that they have room to step on the pedal and cut rates sooner and harder.
From what you've seen in the details of the inflation report, for example, you mentioned rent, which is trending sort of down now. They sort of looked at vacation spending, that kind of thing. Is any of that affecting your investment strategy moving forward? Well,
we've remained, so particularly within our TCIP real asset private pool, we've been overweight on the residential side for 6 to 12 months now. It got beaten up when the population, the immigration messaging was we're going to clamp that down. Population growth was coming off. Interest rates were coming off, and had risen and were starting to come off. And they got beaten up. They were off about 25%. If you take an equal weight basket of the main ones. And we went, well, it's nice defensive play. There's also U.S. real estate in there, so if there is a tariff play, that's helpful. You're bringing some currency risk into there. But for all intents and purposes, there was an opportunity there. Now, they clawed back half of that gain. So while rents, the inflationary aspect of rents did come back down, they're still higher at the levels they were in 22, give or take. So rental rates are fine. The turnover, when you release a new property, that's good. People are pulling back on development, so less supply is coming down the pipeline. So we remain optimistic in that area of that portfolio in terms of our residential. Good values to be had.
So talk to me about the stocks that you like in that space.
Well, you have to, if you go to Cap REIT, Canadian Apartment REIT, it's big. It's got half in Ontario. It's half outside.
I was going to say, remind me geographically.
Yeah,
because
half outside of that province. So it's got a nice diversification in there. It's got lots of units. Its price point, I'll say, is middle of the pack. Because what's happened with condo markets not selling, people are renting condos. That's pushing down the prices of rental rates for condos and for apartments because people go, I can move to a spanking new condo with a pool and concierge versus an apartment. So that's pushing down rates. That's why I was interested to see the inflation number. That wasn't that bad. There's still growth there. So they're in the process. They've had, an older portfolio that they kind of continue to turn over and drive that to a newer portfolio. They've got financing capability, they've got some expansion capability, and their growth rates should be, pretty decent. Call that, a 4% net operating income, same property net operating income next year. So that's good. Another one that is positive is Morguard North American. It's got more 60% in the U.S., again, and a little bit of a hedge down to the U.S.
Okay.
And its growth, it's probably got about 20% upside over the next year to analyst targets. And it's trading at a higher discount to NAV. So there's a possibility there that that could augment, it's smaller, but it could augment the returns of a portfolio.
Chartwell is another one that you like. And, it's the side of the economy that we kind of tend to ignore sometimes. The older population, people moving into homes because they need some help. And you like Chartwell.
Well, demographic tailwind, that's for sure. Coming out of COVID, I mean, they obviously had struggles in there, as you would expect. They have boosted their occupancy rate up to the 90%. They're shooting for a 95%. I think that might be a little hard to come by. Unfortunately, there's natural turnover when you're talking retirement homes, and they are more predominantly focused on retirement homes as opposed to long-term care, which is a little bit more government funded. They've just reorganized the deal with Well Tower, kind of gives them a chance to focus in on properties, wholly owned properties. They've also made some acquisitions of late, because again, cost of construction versus acquisition, cost of construction is prohibitive. So they've got the foot to grow, and they're getting that nice operating leverage coming through. So, you go from an 85% occupancy to a 95% occupancy, or 90% and then 95%. You don't need that much more in the way of human resources or technology systems and what have you. So the operating leverage is working for them quite well now. And again, we're getting older, so again, that tailwind. Having said that, they've had a couple 10% drawdowns. It's not cheap today. And again, they're at 50% total return over the past year. So, people that own it probably have to have some thought about their rebalancing and capital gains. People that are new to the theme or to the thought of it, might want to pick their moment and wait one of those drawdowns before they edge their first capital in.